There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We want to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for a free trading education event. Call now.
Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darsie, Editor-in-Chief, and together we bring you the Morning Call. So Scott, this morning we walked in and futures were down 6 or 7 handles, but now we've bounced all the way back to positive territory, and that was after some weak data, some weak PMIs from Europe and China, and European markets have helped lead that bounce off the lows.
I don't know what time you walked in, but that was like at 4:30 in the morning. You mean
I'm an early riser. Come on.
Maybe when you open your eyes, exactly. When I opened my eyes around 4:45, I'm like, oh, we're down 6, 7 handles. Makes a little sense. And then by the time you're on the ferry on the way in, we're flat, and everyone's like, what just happened here? But that's been the way the market's been going, where people aren't getting the setup they want. And as far as the PMIs, China was weak, but that market's been weaker. That index, I think, was down 2.5%. So no one's really expecting that much out of them. Europe's been something that's been a little bit more focused. Is growth really slowing there? What are they going to do with austerity? So PS, they came out with some weak PMIs. There's talk that they're lifting some of the austerity measures, and their indices are in the green. So with that said, now ours are back in the green, and we're smack in the middle of the right side of this range that traders are just maneuvering. So it's like kind of status quo.
Yeah, it's like choppiness and indecision have been the biggest characteristics of this market, and are we having austerity? Are we not having austerity? Do we have a head and shoulders, or do we have a macro uptrend that's still intact? It's a lot of questions that are really hard to answer right now.
Yeah, well, that's why we talk about time frame. And as far as macro investors that are staying the course, they're being rewarded. They're being rewarded in a lot of quality names. And as far as the S&P is concerned, we've come such a long way that, why wouldn't people question the fact that if we had a potent week to the downside like we had last week, could that lead to some lower prices? But as of right now, the bulls and the bears both have valid points. You look at the chart here of the S&P and you will see that, look at the trend that started from this nice little right dog reversal back in November. This is a nice gradual trend that we just tested right here, which was last week, I think last Thursday. And what did we also test? The 50-day moving average. And this is a nice level of support that is holding for now. The bears would say, though, look at the move that we had from 1597 all the way down here. So why would it break here in the first time? And if you had a high level stop looking at this kind of breakout failure, it didn't matter. If you were stopped out here, you had the capabilities of just say, buying a little bit on support, same ways if you were able to, if you covered on major support, now you have the luxury of testing, 1565 to 1575. So it's really a very tactical tape. You'd have to be very, very tactical, or you just have to have, a hands-off approach where you're putting funds in every month, because if you've been doing that, look at the nice trend that you had here, and you haven't really had to lose any sleep at night. You just have to know what trend you're trading.
Yeah, and there have been several sectors that we've talked about that have been showing faulty signals as potential evidence for a deeper correction in the market. And one of the reasons we were able to bounce yesterday is that we saw the home builders especially, they were sharply lower after some weak existing home sales data, and they were able to bounce during the session to help lead that market reversal.
Well, a lot of those weaker sectors have been holding more intermediate support. They broke like accelerated trends, but they're holding in there, so the market's not going to fall apart if they hold in, especially on bad news, because if a group doesn't go down on perceived softer news after a pullback, then people will say it's priced in. If you look at the chart of the home builders, you will see that, if you look at the size of the move that started all the way back here, you draw this macro trend, and this macro trend is still intact. You look at this more intermediate trend, which is something that we trade in, and it did break, but we held here. So you take a closer look at this potential head and shoulders pattern, the left shoulder, the head, the right shoulder. It's still somewhat valid. Look how long this took to get put in place. But at this point, I think the home builders were upgraded again, actually upgraded this morning, so maybe somebody knew something. So at this point, if they reclaim the 8 and 21-day moving average, you then almost could change this pattern a little bit to more of a channel, okay? Because that's what these things turn into if they just need time. A channel to then digest what's been a huge move, and then you see whether or not, with time, with digestion, they continue to go, and that's what's been the trend. You can't press stocks or groups that already had a pull in, you actually have to cover and wait and see. And one of these times it might change, but until then, it's been a little painful to anticipate it, especially because of the opportunity cost of not getting long into support.
So we'll jump into the sector spotlight now with another sector that has been weakening over the last few weeks a little bit, but yesterday and the last 2 days, they've been able to bounce a little bit. And this morning, we have some upgrades in the sector, and we're talking about the banks. We have, we'll first take a look at the XLF, Scott, which is the sector ETF, as you can see evidence of that 2-day bounce.
Yes, but if you take a backtrack, talking about time frames, you look at the trends here, and here you go from all the way back here in September. This macro trend in the financials has been the backbone of this rally. So when you have an accelerated trend like you have right here, on the verge of being broken after seeing the size of this move, of course people are going to take a little bit of notice and get a little bit, just say little risk off, which does make sense. But if you're trading it short term and you look right here, you'll see a little bit of a double bottom here. B, is still holding the 50-day, and now, if we sustain this up move because of some of the upgrades in particular stocks, all of a sudden this too then turns into a channel. And then if you took risk off in here, like maybe you did over here when that Italian election fiasco hit, then after holding a little bit, you regroup, you reposition, and then you continue. So right now at this particular point, I wouldn't be chasing this little area right here, but the longer we stay above this and go sideways, the higher I do think you look at the weekly chart that, all of a sudden the XLF, which I believe we did talk about in our thesis, of it could be this could be in the 20s at some point. Look at the move that it's had. The XLF has been absolutely annihilated, and, next real spot here does come in, well above, this is like 20-ish. So you have some room, 20 to 22.
Yeah, and Bank of America is one that it was highlighted in your 2013 prediction thesis about. That's one that felt like it had a lot more upside in, this year. And this morning on those upgrades, Bank of America is up about 1.5%. And that could be another one that gets some legs again after these upgrades.
Well, another case of timing and what time frame do you follow. In the thesis, I think we talked about 14 to 16, something like that. The upgrade today was for 16. Lately, it's been in a corrective phase, which we've seen a few times during this very strong uptrend since August. And you look here at the chart, you'll see, last time after this move from $8, it came up. It took, almost 3 months for it to consolidate, tighten up before giving you a nice core entry right here, and then it flagged and continued. Now look at the size of this channel. Obviously this size channel has to be bigger because of the size of the move that we've already seen. So here we are. We touched support. Okay, coming off of it, I think right now it's opening into these moving averages. So let it hold the middle ground here for a little while. Hopefully, if you're a macro investor, you're still in Bank of America, because I still think that if you go to the weekly chart, you will see that, look at this channel here. I'd see for no reason why it should not at least tag the 200-day that's moving lower. And if it reclaims the 200-day, I think you could still see somewhere into this, you look to the left here, and this is where a lot of this, just not say congestion comes in, and that's somewhere between 14 and 16, which is the reason why we figured that could be a target for 2013.
And Goldman Sachs has been actually one of the weaker banks of late after its earnings report that actually seemed like a solid earnings report, but the street doesn't seem to like it. But yesterday, Goldman Sachs had a nice little red dog reversal. It wasn't blaring like we say, but it is perhaps evidence of a short-term floor at least.
Yeah, and I was looking at this yesterday. I was short, long at like 2 different times yesterday trading it. It wound up closing on the highs. If you look at the chart right now, just tactically, above this 140.90, there's no reason why you can't try and trade at some kind of tactical bounce to at least 142, which would be, not even that, that higher, as far as, or not a big expectation. And then at some point, maybe 144.74. So if these banks want to have any kind of move, there's no reason why tactically you can't, see a move back to 144.5 if you're looking to ride something. And Goldman's probably a good vehicle for that.
And Wells Fargo is a more risk-averse financial institution, a slower mover in the group, but it's another one that held key intermediate-term support levels, and it looks like it could be headed for a bounce after bouncing off those key levels.
This one is not one that like traders like to gravitate. I think I tried this a few times during the bank rally, and it like lives on its own island. You have Revis Island, you have Wells Fargo Island, and unfortunately Revis is now in Tampa.
Island's in Tampa now.
Yeah, so go fishing over there. But with that said, we won't even get into the Jets. Which you're a fan of the Jets?
A little bit, yeah.
Unfortunately,
but it's kind of hard to be a fan of the Jets right now with the circus that's going on over there. But
okay, so as far as Wells Fargo, as an investment vehicle, I think if you're looking for bank exposure, maybe own Wells Fargo for the long term and just stay with it, and then look to trade some of the other ones that do trade a little bit better. And one that does trade a little bit better lately is Citigroup.
Yeah, Citigroup had one of the strongest reports in the sector, and it tried to hold up, or it did hold up fairly well during that market turmoil last week. It was sort of succumbed to the larger market weakness. It was the baby got thrown out with the bathwater, but as this week things have started to perk up a little bit.
That's a horrible visual.
Yeah, right. Citigroup looks like one that could lead the sector. We've talked about there's been rotation within the financial sector, and different banks have led the way during different quarters, and Citigroup seems like one that could take the lead over this next quarter. Yeah,
Citigroup, just on this phase of this move, is what I bought yesterday.
Yep.
I was looking I probably should have bought more banks, but again, I'm not in the conviction phase where I feel like I want to have back to 8, 9, 10, 12 longs like I did during a lot of 2013, because I did go from portfolio approach back to tactical. But with this said, this is your macro trend in Citigroup that's very strong. Here is your slight pullback. So for me, tactically, I said, what, I'll get long right into this area, and then if it starts to get above maybe 45.50, it gets back in motion, that would be your add. And then if Citigroup were to clear 46.79, then it's really the banks are acting healthy, and the size of the correction, the overall indices will be very limited.
All right, we're going to have a quick commercial break, and then we're going to jump in the trenches with something a little different, some media stocks as we head into the summer movie season.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Welcome back. We're going to go in the trenches, like I said, with something a little bit different in this morning call. And that's ahead of the summer movie season. We're going to take a look at a few movie production and media type stocks. And these are not ones that traders look at too often, but if you look at some of these charts, you see that there's a lot of health in a lot of areas of this market. And one of those stocks that has had a huge run is Disney, Scott.
Well, we talk about being an investor, a trader, whatever it is, or whatever your approach is. And Disney, I think we've had it off the charts. And, we try and wear different hats and go where the money's going, because, it always changes. And I know I tried to be long Disney a few different times and it didn't work for me. And then I look back and I see the chart here. I'm like, what's the matter with me? Look at the size of this chart. I think I was trying to get long in here, and then I wound up moving away from it. And then you had a big breakout, consolidation again, another big breakout. This is why I feel like people on TV, aren't valid when they say, oh, investors aren't in the rally, they're not enjoying it. You know what? Anyone who tries to probably invest in the market that says, oh, let me buy something quality, they're like, let me buy Disney. And right now, Disney's at highs. At this point, as a trader, you can't be buying it here. You probably want to be trimming it. But overall, this shows you that there are high quality names making moves, and not everyone, is sour in the market if you approach it with some type of plan.
Yeah, we talk about Disney maybe not having a terribly actionable setup right now, but I think there are 2 charts within this sector that do have some nice channels forming, and one of those is CBS.
Yep, this one, has been it's had a nice move too, but this is a little bit tighter. If you look here at CBS, you will see that you do have about a 3-month upper area or upper range that's been holding the 50-day. I know it just had a move yesterday, so yesterday was a day that maybe you wanted to get involved, but overall, if it were to break above this 47.42, this would be an action area for new highs here. This looks like it's on the move, and it's doing quite well in a name that traders don't gravitate towards.
And then another one with a nice pattern is Lionsgate Financial, which is another big media movie production company that also has a nice little upper level pattern.
Yep, this one had a move earlier in the year. You take a look at it, right back here or down here into start 2013. It's been trending above the 8-day, just like stocks that we like to ride during a trend, but I did not ride this one. And since then, it's been consolidating. It's in a channel, holding higher. So this starts to get above 24 and could hold above 24. Just like a stock in the tech sector or anywhere around, it could have a nice breakout. Don't matter what group it's in, because other groups are also having moves that are tradable.
Another name is, we dive into a little bit of a different sector within the media companies, is IMAX. Some people talk about how 3D and 3D movies and 3D TVs are a little bit of a fad, but IMAX is a little bit different. It's just sort of a more immersive experience for the viewer. And I know a lot of people have a friend in the hedge fund industry that's very bullish fundamentally on IMAX, and the chart has been confirming a bullish story.
Well, I will say I did go to an IMAX movie theater with Chase, and we saw, I think, I don't know if it's Rise of the Guardians, and it's pretty cool.
Yeah.
Like you're in there, you're surrounded. It's an experience. I feel like there's not a lot of ways to get an experience. Like everyone in their house, or a lot of people have these big movie setups with these big 50-inch flat screen TVs. So maybe IMAX is going to replace a little bit of the movie theater, because to go to just a normal movie theater and pay to get in, and the popcorn. I don't know how much you don't eat that much popcorn. You're a slender fella.
In New York City, going to a movie is outrageously expensive.
Outrageous. So you might as well go like to a premium,
Yeah.
which is like an IMAX type theater. So who knows, whatever. I'm just saying, I'm a little real life could help in stock decisions too. And if you look here at the chart, you'll see that it does have an uptrend, and it's holding in there. It's a little sloppy, but this starts to get above 27.50, 28. It could go again. This has been on the move decent, and just something to put on your radar.
And then a lower level pattern, another movie production company, DreamWorks, has an interesting lower level pattern, if that's your cup of tea, I guess. Scott, let's go ahead and jump into that chart.
Well, we talk about setups, and we talk about relative strength. This has not been showing relative strength, but on an intermediate basis, if you're just looking at it here, you have an overall channel. It's holding the upper end of it. Doesn't look like a blockbuster type situation, but above 1985, no reason why this can't continue as long as the group stays in vogue. It broke above a lower level here, had some movement, consolidated. So this is definitely something you could at least have on your price point sheet.
All right, well now we'll jump into quick hits, and I think a couple of them aren't going to be all that quick, because we have some, in the middle of earnings season, we have some interesting things to talk about. The first one we're going to talk about is Apple, which reports earnings after the close today. I know you've obviously had that well-publicized 40% correction off the highs for Apple, and expectations seem very low heading into the report. So Scott, what's your approach going to be heading into tonight's report? Sorry.
Well, I talked about a strategy yesterday. I think every week and a half, I try and go over like the state of the union of Apple on when not to trust and when to look for a bounce, when to maybe look for resistance. And last quarter, just to let you know, I tried a call spread that went worthless, and at least it was a try, because at that point you thought maybe 500 was an area. So this time at 400. You know what? Why wouldn't I try a little bit again? Because last time, if you just look real quickly at the chart, you will see here's where it closed. Remember, right at this downtrend. So I'm like, okay, if it could break above the downtrend, maybe this 500's enough, and it wasn't. So it went worthless. So having a call spread at least defined your risk, where I lost $5-6 on whatever amount of calls I had. But over a little bit of time, a better trade developed, a better nice trade. Remember, we did this strategy when we said if it gets above whatever, this was like 460, that at least we could have a gap fill to 480, and that made more than what would have been on the loss there. So anyway, PS, we've had a few different trades all the way down. Yesterday I said I'm going to get into 50% of whatever type of call strategy I want to put on, and I think we tweeted, and guys on the floor saw me put it on around 395-ish. And now it's above 400. I don't know what it's going to do between now and the close, but I'm going to either, if it runs away and just say it's up another $8 today, what I might do is I might just sell, maybe 420 calls just to fund what I already picked up, so I have pretty much a riskless call spread on, and then trade it after hours. I think after hours, you want to talk about 420, and then you also have 440. These are your two levels to trade against, and then here is your third resistance. So 1, 2, 3, and then on the downside you have 380 if the earnings are really that bad and they don't come out with anything as far as anything exciting about a dividend. If the dividend is 3% or less, I think it's going to be sold. If they don't do a buyback of at least $10 billion, I think it's going to be sold. And if that's the case, you then have around 360 here with a small point of reference that comes in right around 370. So for me, I'm going to take a little bit of a calls, thinking that if we do get some type of gap up, or not even a gap up, a halt, I want to be involved because I am not trapped here. There are a lot of people trapped in this from 700 all the way down that are looking just for a little relief. From here, if you're not in it, it could be an opportunity. And I'm not saying, rolling the dice would be, okay, I'm going to buy the stock here and close my eyes. No. I think some type of call spread where your risk is premium paid is better. And then if, it's not good, you lose a little bit of money, but then we get some type of setup like we had here where you have the gap down, consolidates, you look for a wide range bar, and you could probably make more money in the equity once the earnings risk is off the table. So at this particular point, it's been a saga, a bumpy, rough saga where a lot of people learned a lot about, detaching from the name of a stock, learned a lot probably about being short, learned a lot about honoring levels, and hopefully you learned enough that next time you see a situation like this, you could either limit your pain or benefit from it. But overall, we'll see what happens after the close. There are guys that will trade it after hours. There are guys that will trade in the morning. Everyone's approaching it differently. For me, I'm going to have some calls into it, just the amount that I'm not really upset if I lose it, because I do think if we open up a lot lower, there'll be better trades and opportunity in the coming sessions.
A tech stock that reported last night and for the second straight quarter delivered a blockbuster report and is trading almost 25% higher this morning is Netflix. Netflix has really had a big turnaround. The stock was trading around the $50 level, and George Soros bought in well below $100, and it's had a huge run. One of the big drivers.
Also, right?
Icahn, that's who I meant. I'm sorry. It was Carl Icahn that bought it.
Soros wish he did.
Yeah, Soros wish he bought it, but he's been too busy fighting Ackman over Herbalife.
And the sandbags.
Yeah, and one of the big drivers for those earnings for Netflix was that House of Cards series. It was the first original content that's been produced by Netflix, and it just goes to show you about how content is king. But let's jump into that chart as we see the major levels on Netflix.
We'll go into the chart. I don't think anyone actually did a lot of options because the premiums are just way too high. Yeah. You have guys who are looking to just short it. Some people were looking to be long it. So I think Mark, who is one of the main influences on our floor, was like, okay, we get above 197, that's all you need to know. And if we could hover and stay above 197, probably get squeezed to 210, 215. So trading it after, I was not taking the risk. Okay, not going short into the report or long, but trading it after knowing your levels could have made you some money. And if you look here at Netflix, you will see this is that level that he was talking about. This is 197 to 200. It gapped above it and then held above it for about 10 minutes, and then all of a sudden you saw 215, 217, and that is where he made his money, and that is where people on the virtual trading floor saw him and listened to him talk about it. So with that said, I'd say people might try and sell the up open at 215. I would say trying to buy it there is very tough. But here's your line in the sand. Maybe it tries to pull back and retest 200, and then if it holds there, that's your entry. Look what happened last quarter. You had a big gap up. You didn't have much action after the gap up. This was, it actually took the following day to get you the follow through. So at this point, maybe trading will be a little limited. So at this point, I wouldn't overtrade it, but just know that I wouldn't chase it up at 215. But the same way, it's not I would just short against the high because who knows, it could go to 220, 242.
Yeah, I mean, and the dynamic duo last earnings season was Netflix and then LinkedIn. Those are both stocks that we have grouped together over the last quarter because they've been extremely strong after blockbuster reports. And Netflix doesn't report till May 2nd, or LinkedIn doesn't report till May 2nd, but it could be another one perhaps that people will be looking at for another move higher.
Yes, this one has been best in breed. They have a similar situation where Netflix has got a small float, very heavily shorted. LinkedIn's different. Small float because it's only been public for 2 years plus. Not as big of a short interest, but the growth numbers are there. The franchise name is there. Last quarter I did a call spread into it. I actually limited my upside, but it was involved. Guys who are approaching it from a macro sense, are getting paid for sitting there and being patient because we talk about new issues. They could be the most exciting situations in the market because they have that actual potential. You go real quickly, first to the weekly chart just to show you, this pattern here that we were outlining so many different times. We had it on our 2013 thesis too as well. Here is that trade above this key resistance that did take a long time. It took a lot of, different earnings reports for institutions to get a little bit more comfortable, but then once it triggered above, it had a nice move. So lo and behold, where are we now? If you're not involved in this chart or involved in LinkedIn, it's still above the 50-day. It's right near this resistance. I would use this 186 as your pivot. I don't know if it'll get above it, before earnings. If it does, use that. It couldn't get going, a week ago, but if it does, that's your area, and if it doesn't until the report, same thing with Netflix, gets above there after hours on a solid report, solid guidance, that's where you buy it, and then this thing could be above 200. And who knows, maybe they even announce a 2 or 3 for 1 stock split and they get smart so they don't become some kind of, blimp in the air that everyone tries to shoot down because of their valuation, when really it's more about supply and demand and growth, with new issues.
And Google is another tech name that reported last week that has been extremely strong. Yesterday there was a little bit of controversy, or whatever you want to say, because early in the session there was a sort of mini flash crash, but Google was able to recover from that, and the chart is getting a lot more constructive after earnings.
Yeah, this one was one of the chosen ones when all of high beta wasn't doing great. This had a run to 844 and then had like a stealth pullback. So right here, if you're looking at it, this is a descending channel. Okay, it wound up having that move yesterday that got contained. I would say at this point it's in the game for higher prices. If it can get above this 2-day high, above 804-ish, you could see at least a quick move to this 814, and then holding above this descending channel puts it in motion for a move back to these highs if the market wants to get a little bit better, and this will give us a sign that there is some leadership if this one could continue in motion and not just continue to chop around.
Moving out of the tech space, Nike is one pattern that we've been listing a lot on Off the Charts and talking about in a lot of morning calls. Is you like to see a stock in a choppy and somewhat weakening market that gaps up and holds higher on positive news or positive earnings, and Nike's had a beautiful upper level flag. It had one, and then now it's forming another one.
Yep, and we talk about in the swing trading course, how to use gaps to your advantage to judge potential movement. And if you look here on Nike, big gap up, held the big portion of it. Here's what was an entry, and now you have another entry. If it gets above 61.49, it can continue.
And then finally, we have Coach reported earnings this morning and is up significantly. The retail space, pockets of retail, especially the discount retailers, have been strong, and this has been somewhat of a laggard, but do you think this could be something that sparks a bigger move in Coach?
Well, it's up considerably, I think 6 points already. If you look at the chart, there's a gap here. I think we talked about it yesterday. It shows you that I guess every dog could have its day, and this has been a dog's, and expectations were a lot lower. So the gap gets filled up right here to about, 58-ish. So, right now I think it could be around 56. You say, let's go to the 5-minute chart. It's actually, went right to 58. So already filled the gap pre-market. So at this point, I wouldn't chase it, but I wouldn't short it. If you owned it in this lower level, congratulations. You flipped a coin and it landed on your side.
All right, so I guess what's your takeaway going into today's session? We've talked a lot about the indecision in the market. What's the stance that you're going to take?
Well, I think last week, after going from portfolio to tactical, I had a little bit more short on the brain. Okay, and then after the action yesterday, I was like, you know what? I'm going to be more wait and see and be tactical. I'm going to, I bought, Citigroup. I have some bank exposure. I'm going to see if I could add to that with other stocks as well. This morning when things were down, I'm like, let me look to the home builders to see if they can go positive, but they're up with an upgrade. I do have Kohl's already on from yesterday, and Apple. I'm going to see how I want to treat that into the end of the day. And I'm just going to keep taking trades. And the longer we stay above the 50-day, the longer some of these patterns rebuild. I'll go from, more tactical maybe to putting some positions on that I could trust, especially after they're done with their earnings. And then maybe we resume. But if we start to falter and breakouts continue to fail and nice reports get sold, then that'll tell us that maybe in the next few weeks we do break the 50-day, we do get a little bit more corrective activity, which I think would be healthy for everyone. But overall, everyone likes when I give my 75% odds thing. I would say the 75% odds that the highs of the year are not in. Just the question is, do we see 1510 in the S&P before we see 1600 plus? And at this point, I think you just have to be in neutral instead of having a crazy opinion on which one's going to come first.
All right, we'll be all over it in the virtual trading floor today, and we'll see you back here for the daily recap this afternoon.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, We teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.